All right, hi guys. It's been a while since I came up with a video on my channel, but I think now is the right time. I have with me my good friend Alex. Alex is, for those who are probably following crypto Twitter and are not living under a rock, is one of the most vocal analysts in the space that I know of. Somebody who's true to his belief systems. He is a fundamental driven trader. That's the best way to describe him. And in fact, he's also somebody who's a big media personality now. With his own big face showing up on YouTube, talking to the bigwigs in our space. And so, the way he uncovers those questions, the way he is able to find insights from these people is amazing. And if you haven't seen any of his work, all of it will be linked right below this video. Do check it out. So, Alex, the frame first. Right. So, you've been posting real-time calls on Banter's Discord 24/7 research for now a long time, and I've been there. I've been observing it as well. And I found some very interesting insights from it. So probably a good point to segue into the conversation. One was obviously lighter, right? You're a big farmer. You claim that you're a farmer, right? So any new perp dex comes out, whether it's variational, I don't know, or others, you're right there. You start farming. And so, lighter, your prediction was $12 per point, right? That was your early estimate. And the market resolved at what, $55 at the peak, if I remember. And then there was another market making bot that you made. I think it was for 01 exchange or something, which got wrecked. And so interesting things have happened there for you. What I want to kind of jump in here is, after looking back into your 1 year doing this, right? What is your record, of making these calls tells you about your own process, both in terms of the wins that you've had and the losses that you've had, and you've publicly accepted that, okay, I was wrong here. So how do you deal with that in hindsight? How does that knowledge help you today?
Well, thank you very much for the intro, Rahit. It's a very, very kind word. So appreciate it, and thanks for having me. So in terms of how I deal with losses, I guess is the question. I think if you're going to be in if you're going to invest or you're going to take out trying to make your money work for you in some way, whether that's in crypto, in traditional equities, whatever it is, you have to accept that there's going to be times when you're right and times when you're wrong. And the only barometer of whether you should keep doing it essentially is your P&L green? Are you, when you're right, do you get paid enough to make up for when you're wrong? And so for me anyway, the most, I have been wrong a lot, and I was wrong a lot more in the past, I guess. And I guess that's sort of the cost of tuition, I think as Benjamin Franklin said, learning from, I'm paraphrasing here, but basically he said that you need to, only a fool will not learn from other people's mistakes. However, it is very hard to not learn, to not have to go through those sort of experiences yourself and learn from them, right? It's much easier to just sort of have someone say, hey, you should do this. I did it and I didn't do very well. You shouldn't do it. And then, just naively, you can go, I'm just going to try it myself. I often find this with this is maybe an irrelevant point, but if you have ATMs in, where you get cash out, sometimes they're broken, right? And you go and you put your card in and it doesn't work. And you tell the person behind you, hey, this is broken. They ignore you. They just go and do it anyway. They got to test it for themselves. They refuse to believe you. So I think just having to go through that experience and just, you just got to learn the hard way, I guess. Some things work well for you, your experiences, your mindset, and some things don't. And for me, actually, what I'm definitely best at is farming. So finding protocols that I think have a real chance of actually getting adoption after the sort of incentives have dried up, and utilizing them and just sort of taking a risk early whilst no one really cares about them. And then, yeah, I think that's probably what the reason I learned that is because for the first sort of 2 or 3 years I was in crypto, I just kept getting wrecked basically. And I was like, there's loads of opportunities here, but I'm not making anywhere near as much money as I should be. And in fact, I'd have been much better off just buying Bitcoin and doing nothing else. And so that was a really valuable lesson. And now there's like a portion of my portfolio that just buys and holds Bitcoin and does almost no thinking, just knowing that the vast majority of things are going to continue to bleed to Bitcoin. Bitcoin is the entire reason for this space exists. Bitcoin is, for whatever it's worth, as long as there's most things are going to continue to bleed to the best assets. The best assets tend to compounding it better over time, and Bitcoin is that asset. It has the Lindy effect. Almost nothing on a multi-cycle time frame has even come close to being able to defeat it. The only things that get kind of close are like Tron and BNB, and even those, if you zoom out, are still bleed to Bitcoin. The only things that tend to do well against Bitcoin are tokens in their like first cycle. So like Hype is in that phase right now. Who's to say whether or not in 5 or 10 years Hype is going to be like more than likely, if history is anything to go off, Hype is likely to follow like Solana this cycle, right? Solana finally was like doing well against Bitcoin, and now if you look at it against its Bitcoin pairing, it's just a horrible chart that's down and to the right. But yeah, I think it's just being able to learn from your mistakes, make enough money when you're right that it makes up for all the times that you're wrong. I think is the key.
Yeah, I mean, you identified that, and one of the things that Claude surfaced for me, and I'm going to repeat it verbatim, Alex, and then my question. So Claude told me that Alex's highest conviction repeatable alpha is the fact that he identifies early stage perp Texas before saturation, farms points aggressively, and then exits via TGE or pre-market. and so it even gave me a criteria on how you decide to identify these farms. And you farm lighter. You are, I think, currently farming variational, if I'm not wrong. You tried your hands at 0 and XYZ, but your bot got wrecked. So we'll talk about that story as well. And then GRVT, and then what, Dream Cash, is it? So walk me through your obsession with farms. Like what's with it? Like, do you think it's a low risk return way of making money versus the traditional thing that folks usually try to do, which is to find narratives like the AI crypto AI agent thing that is happening right now on Base or wherever, right? And then let me just find what's hot right now, try and run the rally and make money. Doing that versus doing these farming, like how do you choose? And what made you come to this realization that okay, maybe farming is a very cool way to do it? And one of the points you made was it's very friction heavy for a lot of folks, so they don't want to do it. Maybe that's the alpha, but
well, I think you can do a lot of things, right? I think that's probably like Claude saying that the only thing I do is farm perp dexes is probably like it's just not necessarily accurate, but I think I am actually quite good at farming perp dexes, and I think the reason for that is I've been essentially like farming, and especially perp dex farming.
Let me correct. That's not what Claude said. It said it's one of your primary strategies.
Yeah. It's a very, very good strategy, I think. And I think the reason that I've been like quite successful with it is because I was farming like perp dexes before Hyperliquid, right? So like I farmed. This is probably people don't even know these things existed. Orderly was a thing. This thing called LogX was a thing. There were like 4 or 5 perpetuals dexes that offered like points campaigns, maybe even more than that before. Obviously like GMX was one, DYDX, but they were like the sort of generation before. There were these perp dexes that sort of did things before Hyperliquid, right? And this is actually what allowed me to use Hyperliquid and go, fucking hell, this thing is completely different. This is different, right? This is much better than these other ones. And I burnt through capital trying to farm the other ones, and they were barely a wash, right? Like once you got your tokens and you accounted for your fees spent and the losses, because it was like you were just trying to rack up volume, it was basically a wash to a loss. So they were really, really bad, which actually made me like hesitant to farming Hyperliquid in the first place, because I was like, oh, all these other ones have been so bad, and like this is. But when I started using Hyperliquid, I was like, okay, this thing is different, and it was different in so much that you logged in once and you just pressed execute trade, close trade, and you didn't need to keep signing transactions. Now, obviously, there's so much friction to signing transactions that it's like a massive ball ache that that enough was almost like, oh wow, this feels like trading on a sex. And this was obviously like when Hyperliquid were going on with their points, and I was like, okay, this is different. This actually feels like a sex. So I put a lot of like time and effort into farming Hyperliquid. early, basically. Well, not even that early, actually. Maybe like 6 months before TGE or something. And because again, I was wasting time farming like other things. But the thing is like by utilizing other things, I realized, okay, Hyperliquid has something that is clearly different. And it wasn't actually until like close to TGE that I was like understood that Hyperliquid was a completely different beast altogether. Which is why when I actually got my Hyperliquid tokens, I didn't dump them at TGE. I held them and I bought more on that first day, actually, when it was like I had like buy order set for like $2, $1.50. They both got obviously never went there, so I had to like market buy at like 4 and 5 and thought I was an idiot. But anyway, it turned out to be like quite a good trade. But I think perp dexes are they have been the easiest way to make money, right? Because if you're trading anyway, you might as well get paid to trade. Like, I don't know why. Honestly, I don't know why anybody uses sexes at the moment, because you pay fees and they don't give you any like token incentives or rewards. The only thing that you get out of like trading on a centralized exchange is you get to grease the pockets of the person who like referred you, which is fine, right? And those people referring, it's like no worries, you should refer. But I think as the end user, like obviously encourage those people to go in. Well, I say encourage, but like it's much better for them to get like some token incentives when eventually the thing tokenizes. So yeah, I think like if you're going to trade anyway, obviously you might as well get paid to trade. And most people, I think that 3 or 4 months ago, Perpetual's dexes got heavy, like just before lighter TGE'd. They were the volumes were so high, it was so hard to get points. But since that time, like volumes are down like 75%. So again, now, like for like variation, for example, you're getting paid like, well for every dollar that you farm, that you put into volume now is like worth $4, just sort of 3 or 4 months ago. So I think at these levels, again, it's sort of getting like the risk rewards kind of skewing back in favor of like, it's worth spending some time doing it again. When the volumes were like $4 or $5 billion a day, it's so high that like you run the risk of, because the way you have to think, sorry, I'm just changing my headphones. The way you have to think about Perpetual's dexes is, it's very simple, to be honest. For every dollar that you spend, yes, some of them have fees, some of them don't, but you still pay the spread. So for every dollar that you spend in spread or in fees, your trade and losses, right? If your strategy isn't profitable, and actually the highest volume strategies tend to not be that profitable, you're trading those fees plus losses for tokens, right? Eventually, when they TGE, that's what's happening. You're trading your fees, your time, your effort, and the spread cost for tokens at TGE. Now, that is either worth it or it is not, depending on the percentage that they're going to give to points holders in terms of the supply, the FTV that they drop at, and your percentage of those points. If the three of those things added up together equate to something that could be like positive EV, like good risk reward, then it's a simple trade, right? That's a trade that you can take, or I have been taking, because it was I thought the risk was worth I thought that those fees and losses were worth the tokens at TGE.
What the trade-off of what it might be priced at in the market when they launch?
Are you talking about variational points?
I mean, any farm, for instance, like the fact that you're paying fees and you're paying the spread, right? And what you're getting is tokens on unlock on TGE day. So if the price of the token is more than what you spend, that's the EV, right?
Yeah, exactly. Well, yeah. So the
and so I need to have some assessment of, okay, is it sufficiently different? I mean, today, like variation for me is very interesting because it's a product which is differentiated to hype versus, let's say a lighter. So I am more inclined. You can do better pair trading, I think, on variational versus on hype, right? Because you can open multiple positions and stuff like that. Otherwise, you have to have sub accounts on hype or something like that. I mean,
no,
I don't know. I don't do that. Yeah. So, you were saying it's not true. So why then? What is the reason for me to then farm something which may or may not be as valuable as hype, or might struggle because everybody in the market really, now cares for hyperliquid. Like even people who were detractors at one point believe it's the next big thing, right? And so, what's your logic there? It's like, how do you do that EV calculations? Because you're making predictions on future token value, which you don't know right now. So,
Yeah, that's
how do you factor that in?
Well, so you've got a few inputs to that like calculation, right? You've got because there's pre-markets anyway. So there's places where you can trade before tokens go live. You can trade their FDV basically. So for Lighter, for example, there were OTC markets, so people were buying and selling points quite early.
Yeah.
There was also like Lighter was listed on Hyperliquid, like 2 months or so before.
I remember that.
It's maybe it wasn't 2 months, maybe it was a month or something. Maybe it's 2 weeks. But anyway, there were places where you could trade what the synthetic version of what the market thought the FDV was going to be worth, right? And so these things exist. They have existed for a long time. The primitive version of this was Whales Market, I think, Whales.market. It was, and they're all OTC. So if you didn't know what OTC is, basically like if let's say I had like $1,000 in points I wanted to sell, and someone wanted to buy, let's say I had $1,000, 100 points, and I wanted to sell them for $1,000, right? $10 a point. I could take $1,000, me as the point seller, lock it in a contract. The person who wants to buy those points puts $1,000 into a points contract. So you've got $2,000 in this contract. And come TGE, I give them like essentially what would be the $1,000 worth of points, or the 100 points what they would be worth in tokens, and I would capture all that $2,000 out of the OTC contract. Of course, as the person who's selling the points, you can just not give your points to the contract if you want, but then you forego your $1,000 collateral that you posted. So the person who was going to buy the points, they still get what they were going to buy the points for anyway, which was $1,000.
Interesting. And I just want to jump in here because that was my next question, or the lighter call itself. You shared very articulately, and you were in detail your exact assumptions with respect to valuing those lighter points. So you predicted $12, but it ended up at 56, and you said you were wrong on the campaign length, you were wrong on the total points, the FDV, like basically every input of your model, and yet the call worked out, right? So
on those though, like I'm always going to underestimate what the points are going to be worth, because I think you have to, it has to be worth.
So my question, Alex, is like how much of that trade was thesis versus just plain good luck? Like the market.
Well, it's not good. It's not good luck, right? Because the whole point is like, okay, so the base case initially was $4, right? So when I first started doing on my X, as like the first post is like that. If lighter points are worth $4 at this level, I think that it's absolutely worth just like racking up as many points as you can, because right now you can get like a point per $1,000, or a point per like $5,000, right? It was at the start, maybe for $4,000, something really, really low.
Yeah.
And so, yes, of course, you can go for these sort of like higher FDV estimations, like 6-9 months out, but you don't know that Lighter's going to be worth 4 or 5 billion, like 9 months before. So you have to err on the side of caution, especially like if I've got like a platform that I'm speaking to. I'm not going to be like, I think Lighter points are going to be worth $50 to $100, because the chance that I'm like right to the upside is quite like low, right? So I want to make sure that if I'm going to burn through $10,000, $20,000, that I'm going to, if I need my base case to, or my like low estimate, I need it to be worth my low estimate. I'm not going to burn 20K hoping Lighter points are worth $50, because that isn't worth the risk to reward. I've got to tie up capital for 6 to 9 months. I can't access it. I'm basically doing an OTC, like an OTC deal for tokens at TGE. They might be worth much less than that. So when I'm estimating, like trying to whether or not it's worth farming points, I'm always making sure that it's worth the like bear case, I guess. So those valuations were like, bear to base case valuations. And if the market conditions are good and everything else, then for Lighter, that ended up being the case, that the market conditions were good. So points ended up dropping at like 10x my base case, and I was already profitable by like a wide margin, by like 3 or 4x at my base case. So the base case needs to be profitable, right? So for risk, if you want like specific numbers, I think when you're farming perp dexes, you need like to be paid 2 or 3 to 1 on your base case. So for every dollar you spend on spread on points, you need to get paid 2 to 3K back. So for every $1,000 you spend, go on.
How did you arrive at that like rule of thumb? Is it
Oh,
like
because I lost a load, right, when I was farming up LogX and Orderly and these other ones. So obviously as well, like it needs to be, it can't be 1-to-1, because then then you make no money. It can't really be it can't really be like 1.5-to-1, because you might as well just go and like actually trade at that point, because it's not worth the risk. You've got to tie up capital for like maybe 12 months. If you think about this, right, every dollar that you spend or every dollar that you lose, that's whether it's in fees or in losses, you don't get that back until TGE. So you're trading your money today for tokens in the future, right? So you are essentially funding that project via an OTC, via you're buying locked tokens. Now, locked tokens carry enormous risk. They carry market risk. You don't know what the market's going to be like in 6 to 9 months. They carry execution risk. The team might rug. The team might not be there. Something might go wrong. Maybe they lose their license. Who knows what it is? It carries regulation risk. You're already in a massively risky space anyway, where you can get good returns in crypto by taking pretty high risk over 6 to 9 months anyway, and you can be fully liquid. You can exit that position whenever you want. When you farm points, you're not liquid at all. So that's why like I'm always going for like I'm always like underestimating what the points are gonna be worth when I'm estimating whether or not it's worth it. Because if let's say if you only get paid 2-to-1, 3-to-1 at the best case, I'm not going to do it. And that's fine if someone makes loads of money doing it. No worries. That isn't worth it to me because of all the things I just mentioned. I need to be getting paid like 10, 20-to-1 at the bull case, and I need to be getting paid like 2 or 3-to-1 at the sort of like base to bear case. Then I'm gonna spend a lot of my effort, my time doing the thing, because these things are not like low effort either. To properly farm perp dexes takes a lot of time and energy, and you could spend that time doing loads of other things, right? Whether that's especially now, like with AI, there's literally nothing you can't do anymore. You're only limited by your imagination and your like creativity, which for all intents and purposes is a massive limitation. Most people are not creative,
which itself is a scarce resource.
100%. Like people think like, oh, now I can do anything with AI. I'm going to be a millionaire. And it's like, well, no, because ideas are very valuable, and most people haven't got ideas, right? It's like just because you can like make Facebook now, you probably don't have the idea to make the next Facebook. You can't just go to Claude and be like, hey, make me a millionaire. And it'd be like, yeah, right, no worries.
I'm sure people are trying.
Yeah, no, for sure. But the actual like to be creative is, I think, probably one of the most valuable skills to like. Well, I mean, I think it always was quite underrated, but I think now it's no longer underrated. It's like the only thing that like really matters for like generation of like a real, good new products, because everyone has the ability now to go and make whatever it is they want, because software development's so easy. It used to cost 100K, 200K to go from like idea to like prototype, right? If you had like a really good idea that you wanted to run and you wanted to get like 2 or 3 developers to like work on it for a year or two, that's a lot of money. Whereas now you can actually get like pretty close to prototype with no coding experience whatsoever, but getting to like prototype requires an idea that is that might get used, right? Which is for all intents and purposes still actually a really, really hard task.
I mean, for me personally, my journey has been pretty simple. I think the key here is more than being creative, being curious. Naval talks about it a lot. Like when I sit with Claude Code or Hermes or whatever, and I have something which is curious, may or may not be related to even crypto. Alex, I'll give you an example. Like I'm a spiritual seeker in one sense. So there are like so many throughout humanity's history, so many cultures and religions which have written tons about how you can become a spiritual being, for instance. And so I built an app, nothing to do. It's just exploration of my curiosity. It showed me so much peer-reviewed books, research papers and stuff on actual practices that people do to elevate their being, whether it's their physical body or their mental states. And I built an app, which had a task tracker attached to it with practices and the whole shebang. And so I think what people are struggling to do right now is switch off the 9 to 5 mindset and go back to how they were as children. I mean, when we were children, we were naturally curious about life and go after things without in pursuit of those things without an end goal in mind. Like I used to play football or cricket or any of these sports without the aim of, hey, I'm going to play for or represent my country at the national level. I was just playing it because it was fun. And I think people have stopped having fun, which is probably why I think that's happening.
Yeah, agreed.
anyways, I want to move on, very quickly, but just on this point, there was another farm that you tried, and you built a market making bot. You were in pretty early. I think it was the weekly volumes were what 200K or so. It's called 01. Walk me through what failed. I think you covered that at length as well on your Discord post. But was that a mechanical failure? And if yes, given your past history, Israel, like you said, you now have a rule of thumb of at least 3x of how much money I put in. I need to make, get a payback for it. So, what did this failure exactly teach you? And was this one of those farms that you would have better avoided, or was it a specific mistake on your part in terms of the creation of the market maker bot?
Yeah, I think I just didn't do a very good job with making the bot. I think if I made the bot now, I think it would be okay, to be honest. So I am not a coder. I haven't got like a background in software development at all. I'm so useless at all this stuff. But obviously with the capabilities that are like put in front of you now with access to LLMs, suddenly you can like do things that I never could do, right? I can build websites, I can build dashboards, I can build models, I can build these things that I used to not be able to do. I used to have these ideas in my head and not be able to go away and build them. And so for me anyway, just for some brief context, 01 is a perp dex that is built on the blockchain N1, and N1 is a blockchain that has like these specific apps that are built on top of it that utilize the infrastructure of the chain, right? That being like super fast, low latency. So it sort of gears itself well to like trading applications, prediction markets, perpetual dexes, etc. And this particular perp dex is like N1's perpetuals dex, right? N1 is backed by Anatoly. So whenever I'm looking at these projects, I'm sort of seeing, okay, who are their backers? How much did they raise? What is the low estimate for what they raised at in terms of their FTV? Okay, so this is like one of the key inputs into like when you're working out what something should be worth. Like for variational, right? Variational just raised 50 mil. It's unlikely they sold more than 20% of tokens for that 50 mil raise. And it's unlikely they sold less than sort of like 5%, I think. So in that 5 to 10, so if they sold 20%, then they're worth what, like 400 mil, and if they sold 5%, then they're worth closer to like 1 bill, right? So they're in that sort of range. So you can go, okay, so they just raised money at between, let's call it, just for argument's sake, $500 million to $1 billion. They're probably going to TGE at a low estimate, the bottom of that range, maybe towards the top of that range is like a low estimate for what they're going to TGE at. Fair enough. Could be right, could be wrong, but it's like in the past that's been the last raise before TGE. It's rare projects in crypto TGE at less than that amount. So that's just like a fact, right? For N1 they raised like I think 7 or 8 mil, and it was super early in that DEX. It was like week 2 or 3. And so at that point, every dollar you're trading at that point, right? Every dollar you spend in fees and losses is worth probably 10 to maybe even like $50, 10 to sort of maybe 20 to 30 weeks into the future. Does that make sense? So in the first week or 2 weeks of like these perpetual DEX's lives, you can get so many points per dollar relative to how many you could get in the future. Just as an example for variational, right? One wallet on variational had one short long position open on Uniswap and Meteora. So like 10K short Uni, 10K long notional this is as well on Met, held for 3 weeks. That one 20K notional position had like $1,000 in the account, was worth like 200 points.
Wow.
Right?
Okay.
Unbelievable. Like unreal return.
Yes.
So that's $20,000 of volume, $20,000 of open interest, held for 3 weeks, was worth 200 points. Just to give you an idea, you would struggle right now to get 1 point per 50K that you trade in volume.
Oh, wow.
So that's like 250 times better value, right?
And is that only the first 2 weeks? Like,
Well, it's just when you're early, right? So I've never been that early, right? Whereas 0-1, I was like, okay, I'm super early here. I'm just going to try and create a market making bot that just does a bunch of volume, racks up a bunch of points, and let's just see where it goes. So I ran this bot. I put like $500 on this bot or something, and it got like a decent amount of volume. I think it might have done like $1 or $2 million in volume in sort of 2 or 3 weeks, and it just burnt through the entire capital stack. Had no money left in like 2 weeks. So the bot got wrecked. We're yet to TBC how much those points are going to be worth. I would be surprised if I don't get my $500 back. I would be surprised if I don't get sort of like a base case of like 3 or 4 to 1 on that. Maybe, you know, there's like it gets picked up like variational is getting picked up now. In 6 to 9 months, maybe this gets picked up. And then, you know, if they're doing somewhere in the region of 3 to, or like maybe around $1 billion a day in volume by when they're like 3 months out from TGE, they're probably talking like 50x on those points spent. On that point spent, I would imagine.
Interesting. Okay, wonderful. I mean, a lot of discussion around farms, Alex. So now I want to pivot from farms to frameworks. And my first question to you is that you know, your long short basket has been running for months, and the criteria is like fairly in your face for the entire industry. Actually, it's like long, really good, fundamentally strong projects, which is basically, you know, high float, right, and real revenue, and short, basically a basket of projects which are, I think in one of your, I was hearing one of the morning calls and it was short or L2s. Somebody asked you, how do you decide what your short basket is? So, you know, one thing you said was this doesn't work when alt season hits and everything correlates. So, you know, what's the, like when that failure mode opens, right? How do you know when the thesis is broken versus the market is just being noisy, you know, and in this point, and that I am right on the basket that I've chosen to run?
Well, the thing with like, so with this is like thematic investing, right? You have like an idea and you have a theme. You need to let time do its thing for that theme to play out. Like if you look at any token basically against Bitcoin on the daily time frame, on the weekly time frame, sometimes it can have rallies against Bitcoin. Yeah. But it tends to, on the monthly time frame, on the yearly time frame, just bleed out, just be down and to the right against Bitcoin. So what is the difference? It's time, right? You have to give these Bitcoin enough time to dominate these things. You have to get, so this with this long short basket, you have to give time. It's like it's respect to do its thing, because things are going to be volatile and noisy on like shorter term time frames. So the way first of all, it's 2 baskets, right? It's long and short. You summarized it relatively well. What I don't like doing in the short side of things, obviously not financial advice, you should not take this and go and deploy this strategy. This is just like an idea that I have been running and been using for myself. on the short side of things, the things I'm putting in that short side are things that are no value accrual back to the token. There's a lot of things like that. Things like governance tokens and nothing else. Things that have high...
At this point, Alex, it's 90% of all altcoins.
Yeah. Oh, more, literally more.
99%.
Things that have, things that have high FTVs and low-ish floats. You know, let's say they're 25% unlocked, 50% unlocked. So you know that the token or the market cap is likely to grow. So the token price cannot grow if the market and imagine the market cap comes down. So just like FTV is the total amount of value if all the tokens were on the market today, and the like market cap is the value of the market cap of that token or of that project today, right? So if the fully diluted valuation is up here and the market cap is down here, let's say there's still like 50% of tokens to come into circulation, then if the market cap remains the same, right, that means the FDV is coming down to meet the market cap, which means the token price is reducing. This is what like supply side inflation is, right? It's literally inflation. Right. Obviously, inflation drives down the price of the underlying, with all else being equal. It's why dollars are worth, you know, $1 today is worth 99% less than it was 100 years ago. It's the exact same mechanics. And so these things just exist, right? And so the amount of buy side pressure to push up to soak up all of those unlocks is, well, it just doesn't exist at the moment. Crypto, I did a show on this a few maybe like 3 or 4 months ago on the amount of unlocks that are happening like every year, and you're talking like between now and 2030, crypto's got to like absorb about $250 billion worth of unlocks, right? It's like $75 billion a year. Do you think there's $75 billion of supply side pressure for things like Optimism and Arbitrum and Celestia? It's like, absolutely not. But it doesn't mean these things can't go up in the short term. It just means that most likely in 3 or 4 years, when these things are fully unlocked, the chance that their token price is higher than it is today, I think personally, is very, very low. The chance that their market cap even is the same as it is today, I think is low. So even if their market cap was to remain constant, then their token price would come down. I personally think their FDVs are going to continue to compress anyway, because I think they're relatively overvalued for the most part, a lot of these things. And we've seen that play out in the past, you know, like tokens do very well, and then they don't tend to do very well afterwards. And people realize that, you know, this isn't the future of finance, and it's fine to not have 25 L2s and, you know, everything else. Not to say that every L2 is a waste of time. Like, I think L2s that are application specific might do very well. Lighter, for example, is probably the best example of an L2. Lighter's an L2, if you don't know what, like Lighter, the perpetuals DEX we were speaking about, it's an L2. It's a very successful L2 in terms of L2s. It has the most transactions on all of Ethereum. They have the most, like, what's the highest TVL, really, highest TVL growth across the entire Ethereum ecosystem. Yes, Arbitrum's probably got higher TVL in terms of its total magnitude, but a lot of that TVL is actually tied to Hyperliquid anyway. But most amount of transactions, most amount of daily traded volume. Yes, of course, it's a perpetuals DEX, so these things are skewed anyway. But Lighter is a breakthrough Ethereum L2. Most of those other L2s they're not really required, right? One L2 would be fine. You could do everything on Optimism. You could do everything on Arbitrum. You could do everything on Linear. You could do everything on ZK Sync. Like, at least ZK Sync is trying to like create sort of like private, you know, side chains essentially that are making that are doing something for institutions to like come on chain. Like ZK Sync is arguably, it's like standing out in that regard. Things that stand out, whether they're niche or big, I think have a chance. But I think a lot of these things are just like, they just went big, decided that they were going to be the place that all liquidity was going to flow to, realized that liquidity is fragmented anyway, and there's not really much reason for them to be the liquidity black hole that they thought they were going to be. And the fact that they've got to compete against 6 or 7 other of these like liquidity black holes means that none of them do a very good job of it in the first place.
I mean, you spoke about governance tokens, like most of them are sheds, and this brings me to my next question as well. Another point that you've made for the longest time, you've been consistently holding that position, is that market today is 90% infra in terms of the total market cap's, you know, share. and 10% apps. But this has to change, right? And this is the shift that you predicted, I think, about 6 months, 8 months back. Now, looking back 6 months, do you feel that position still holds? And as a counter to that, of your list of tokens, which are app heavy, right, like Hive, Meteora, or any of those, which ones have actually failed that filter test for you now that you look back? And do you still believe that?
Yeah, so I think that actually ties into this sort of like long short basket as well, right?
Yeah.
Like I think generally having a thesis that infrastructure is going to bleed, the infrastructure layer of crypto is going to bleed to the application layer of crypto. Again, is like a thematic thesis that I continue to hold because the vast majority of crypto's valuations, like 90% or so, this is not including Bitcoin, obviously, is in the infrastructure layer. So that's so much value in what is essentially just the scaffolding for like why for crypto. Now, don't get me wrong; it's obviously really, really important, and actually, it's really important that this stuff was invested in. And thank you for your service. Like, thank you for your service, but probably you lost a lot of money. And actually, it's not even the people who invested in it, right? They actually made a lot of money. It's like the poor people who came and bought this infrastructure stuff at the peaks that are going to be the sort of like, you know, fallen samurais on the sword that just never recover.
Yeah.
Because what is the entire point? Like crypto as an industry is funny, really, when you think about it. It doesn't need people think it's this like this separate microcosm that like needs to exist. No. Crypto needs to infiltrate into everything that's important in real life. Like you don't want to know that you're on blockchain rails. The reason you want to use blockchain rails is because it's more efficient, it's cheaper, and it's better for the end user. Eventually, right now, oftentimes it's not those things, but eventually it will be those things. Like blockchain rails are better. Businesses that exist on chain, for whatever reason, are more efficient businesses that are better. Right? Like Hyperliquid is the most profitable company in the world per employee. Why is that? It's because it exists entirely on chain. It doesn't need to pay like Binance and Bybit. These companies have to pay enormous fees
IT
for
costs.
security. But for security, right? So because they're holding users' funds. That's a disaster. Like Bybit had to fill a $1.5 billion hole because they were holding billions of dollars worth of Ethereum of other people's ETH. That's a massive security cost that has a massive risk if things go wrong. If things go wrong for Hyperliquid, token price goes down. It's not good, but it's much better than having to fill a $1.5 billion hole out of the money that your company's made, obviously. So they have these enormously reduced securities costs, especially for like something like Hyperliquid, right? And this is part of the reason why on-chain businesses are just like far more efficient. So
yeah, we're seeing that. We've seen that with cards as well. We're seeing that with a bunch of these applications which are actually making a lot of money. And when you compare them to their traditional, TradFi competitors, it's just amazing to see how much of that value accrual is happening with a fraction of the costs or resources, whether it is employees, or the compute that you need to deliver all of these products.
100%, yeah, exactly right.
Okay, I want to segue now to the next section, which is basically, the 3 tension points between my thesis and your thesis. Not really tension points, more like extensions, but good for discussion. First one is Canton. Like, you're a big Canton bull. Of course, you mentioned on your Discord that you sold on the DTCC news, right? And my thing is, like, your bullishness on it is that RWAs are expanding, and Canton, as a result, will benefit from that rise. My question is, when you look at, when you lift the veil and you try to look under the hood, you see the whole infrastructure it works like, like these subnets. That's a good example. So you have private synchronizers, which is where the Broadridge, repo market daily $300 billion odd settlement happens. And then you have the global synchronizer, which is when these subnets, like let's say a Broadridge subnet has to interact with a JP Morgan subnet. That's when the global synchronizer captures fee and creates a burn mechanism to reduce CC supply and hence raising the cost. Of course, another trigger point was the halving of the emissions itself. Like when it went down from 45K to 22K or something per day. But how do you I mean, but even with these new emissions, right, reduced emissions, they will have to make $3 million a day or something just to break even on how much is being emitted at current prices versus how much the global synchronizer is making in terms of money. How do do you still believe that? Like, what's your point generally on this specific situation with regards to Canton?
Yeah, so I wouldn't say I'm like a massive Canton bull, to be honest. What I think about with Canton, right? The thesis with Canton, for me anyway, is relatively simple. To be honest, I was buying it when it was like 5 cents. So it's now like whatever it was like the other day, 16 cents. I took profits on a lot of those positions because
Yeah.
the thesis kind of, it hasn't played out, but the returns I was looking for kind of like played out right. The thesis back then, and probably still is today, to be honest. Look, if the chain, like, why is Ethereum so valuable? Why is Ethereum worth $250 billion? If you were to give me the top three reasons, like real concise, what do you think
Yeah,
that would be?
I mean, three reasons is basically what Vitalik posted yesterday, right? One is crops. It is probably the only chain that I can say with confidence will be censorship resistant, open, permissionless. Two is their pivot to privacy with Kohaku and stuff. With Railgun, we've seen that performance as well. And three is, of course, formal verification of all code, which I think is very important in the age of mythos. But underlying all of this is they secure so much of TVL. Like, despite all talks of Ethereum being dead, there's still 50% or more of all TVL across blockchains.
Perfect. That, I mean, I couldn't have said it better myself. I actually love speaking to you, Rahit, because you understand the actual like infrastructure so well. It's awesome. So could not agree more. Like, Ethereum's value is tied to its TVL. If Ethereum's like a RW, not even RWA, like Ethereum is so valuable because it has so much TVL tied to the platform, and that's the entire thesis for Ethereum over time. Is that, look, it's got this liquidity, it's going to pull in more liquidity, it's the most secure, it's got the best security, blah 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 blah. Fine, good points, well made. Ethereum is very expensive. A lot of it's priced arguably to perfection already. Like, it's already priced like it's being used 10 to 100x more than it's being used. But by the time it gets used 10 to 100, that is how markets work. Markets are forward looking, so the market thinks it's going to get 10 to 100x more use. Fine, no worries. Okay, value it at 250 mil. No worries. Canton's very simple, right? Canton has more TVL than Ethereum if what they say is true. So if TVL on chain is a valuable metric, Canton's trading at the cheapest market cap to TVL ratio in all of crypto. If private transactions on chain are actually something that holds value, Canton is inherently undervalued. Now, that doesn't mean that it is or that it isn't undervalued. It's just that if that is true, if TVL on chain is valuable, if having the ability to have to bring institutions on chain is valuable, then Canton is too cheap. Was my initial thesis, right? At $5 billion, whatever it was back then, I think it was like the supply is infinite, to be honest. So like the idea was eventually that the chain gets the cantons, the little subnets that you said, get used so much that the token supply is deflationary. There's a halving. There's like sinks for the token, etc. But you're right. The incentives at the moment are such that basically they're paying a lot of money for people to go and use the chain. There isn't like it isn't a slam dunk anymore at like whatever it is, sort of 16 billion FTV. But the thesis, I think, is like relatively simple. If RWAs coming on chain, or TVL, especially in the form of RWAs coming on chain, are going to be pushed into the tens of trillions, quadrillions, right? That's their entire like thesis. We're going to have quadrillions on chain. The chain that captures all of that TVL should have some value. If Canton are the chain that captures that, they should be quite valuable. Now, the supposedly they have these like essentially what are not private but like kind of off-chain, on-chain TVL, and it's kind of separate. So if you go to rwa.xyz, they actually have to change their tracking of metrics because Canton had so much TVL that was like unreported. Correct. They sort of changed their sort of like tracking of it, and I forget what they call it. I'm just going to log in quickly. They call it distributed or represented. So these ways of like tracking TVL are different. One's called represented, one's called distributed. Distributed is what is like distributed across multiple chains. You can track it yourself. Represented is like, I guess, for the most part, self-reported, right?
Got it.
And for the time being, Canton has like almost 400 or $350 billion according to today in terms of represented TVL, which is enormous, right?
It is enormous, but if it doesn't touch the global synchronizer, then they don't accrue any fee. If there is no fee, there is no burn. If there is no burn, there is no Canton deflation, and there is 22 million Canton being printed every day versus what 650K in fees from the global synchronizer. So the math doesn't math for me right now.
Yeah, for sure.
The numbers are awesome.
The idea is that all of these cantons are interoperable, and they are and they do all communicate with each other. That is sort of the long term goal. But you're right. Like it's unknown because it's not fully transparent, not fully on chain. So
Right, exactly. Okay, another thing was the on-chain inference trade, right? Like, I mean, there is nothing on-chain about it. Everything is centralized, anyways. But VVV, let's segue to VVV and Dolphin. You made a 3-part DCF model for Dolphin specifically, and you had 3 triggers for it. One was the open router revenue. The second one was the Venice default model, and I think the third was, let me just get my notes in. I think the third one was the fact that where is it? 1 second. Okay.
Venice.
Yeah, and then there was the deep
thing.
Deep in network revenue, and you said 2 of the 3 are now eliminated. I don't remember which ones. You said open router revenue is overstated and unlikely to be meaningful, and deep in is, as we know, the entire sector is early, right? No matter how much innovation they do. So that leaves Venice, right? And you think Venice is sitting close to the ceiling, right? Where like it stopped, at least the local top. So the question is, I mean, does the pod have any value that's independent of Venice? Like, I mean,
that's the question.
Yeah. Is it, or is it a permanent, like, Venice derivative, in which case I'll just wait for Venice to crash to $2 again and then start buying Venice?
Yeah, I think that is the question, really. I think the reality is, right, the reason you have to ask the question, like, why has Venice done well? Very simple, right? Venice has done very well because, number one, it has like an OG crypto founder who has like credentials and trust in the space. It's very, very, very important. And actually, it was one of the easiest things to, I can't believe I just didn't buy Venice when it was cheap, right? Because it was so easy to just bet on Eric. Eric is someone who like absolutely isn't someone who's going to try and rug a token. There was always a reason for Venice, for like the token to exist. He was always trying to build something that was bigger than like, this is a token that we want to try and make some money from. He was like, no, LLMs are capturing way too much of your very valuable data. We want to apply some privacy to that. This is a product that has a real reason to exist. If people use it, fundamentally, it's almost like he doesn't give a fuck. He wants it to exist because he thinks it's a principled thing that must exist that is currently not being done. What a great reason to make a project. And how mental are all of us for not just like going and buying it when it was cheap? Anyway, that is a perfect hindsight. And so, good founder with a real vision for the project to exist in the first place. The token itself has genuine value accrual. Yes, it's not necessarily to Venice, it's to like the sort of like DM token, but it doesn't really matter. Venice, VVV, and the sort of like DM token basically trade and should always trade basically 1-to-1. Arguably, at like really extreme supply constraints, DMs should outpace Venice, but kind of irrelevant. The long and short of it is, look, there's a token with genuine value accrual back to the token as a result of that value accrual, and the fact that it has users and ever increasing users, right? Like we've seen, they passed like 3 million users, whatever it was, a week or two ago. They're actively growing in their, they're getting users, those users generate value, that value actually goes to the token. Great, reasons for the token to go up. In terms of how much it should be worth, it's kind of like hard to say that because they are just like it's not that people are like comparing them to being like, oh, OpenAI are worth 850 billion. Well, Venice should be worth like some portion of that. It's like, well, no, because they're just like applying a layer to what is essentially
built by OpenAI.
Yeah, other people's IP.
Correct.
Which is a great thing to do. Actually, maybe that's the thing to do.
And we have so many examples, Alex, in the TradFi world when you had individual companies, and then somebody came and wrapped it all together and offered you a better way to access it and blew up. Like Amazon is a wrapper on every other e-commerce platform that exists, and look at the valuations, right?
Yeah, exactly. That's exactly right. Like those wrappers. This is again like the application layer should accrue more value than the infrastructure layer. There is an argument that like Anthropic, OpenAI, these guys are the sort of like pioneers that are walking up the mountain. They may well be casualties. They may well be like sacrificial lambs for the stuff that they produce, because the stuff that they produce obviously has value.
It seems like that now. Anywho, I want to pivot to the last like tension point, which is you published a video on RWAs recently. Your claim was it's blowing up. It's like what, $27 billion now tokenized, and that's like 10x in 2 years or less than 2 years. My point is different. I mean, like, great, all of this tokenization is happening, but the real thing is utilization in DeFi, and a lot of it is, I call it whitelist hell, right? Whitelist prison. Like, the issuers don't want those assets to be used as collateral in DeFi, whether it is, BUIDL by BlackRock. They have it specifically in their smart contracts. They report it in their annual reports as well. Like, we're not going to do that. And so, they're okay farming the T-bill yield. They don't want that excess exposure for whatever reasons. Maybe it is the DeFi hacks and stuff. But my structural argument here is that unless that money flows into DeFi, I just don't see how even Clarity helps this, because because this is a business decision, right? This has nothing to do with Clarity. Clarity will allow you to have legal guardrails around it. But the decision that I'm not going to participate at all because of XYZ, or I don't want it, is very different. I'm curious to hear your thoughts about this.
Is the question, is RWA TVL actually value accretive to the underlying infrastructure? Or something else?
Yes, exactly. Like, let's say a Maple or a Centrifuge or any of these bets that we're looking at Ondo, who are tokenizing stuff and putting it on chain, or BUIDL launching it. If it doesn't flow into DeFi, it doesn't like meaningfully expand the TVL of DeFi. What does value accrual look like in the age when everything is going to be tokenized, but it's going to be behind these like private bodies who are not willing to unlock it and bring it really on chain in the sense that it will interact with the rest of make the capital permissionless, right?
I think both things are true, right? I think you're going to just the reality is permissioned stuff has been underrepresented on chain, and over the last year, or 2 years, if you look at DeFi TVL in 2021 was the all-time high for DeFi TVL. In 2025, it never broke that high. So DeFi TVL has been down for like 5 years, right? And when you think about that, like inflation adjusted, fucking hell, it's dire to look at. Because that's during a time when the inflation's been like some of the worst ever, right? So in terms of its like real economic value on chain, or real like inflation adjusted value on chain, it's really, really dire to watch or to look at. Whereas if you look at, this is the stat that I did in that video, if you look at RWA TVL is up like 27x in the last 2.5 years. So in that period, RWA TVL has outstripped the growth of DeFi TVL by a factor of more than 50 to 1. So it's clear where the direction is going. It's going more RWAs. Yes, they exist somewhat on chain, exactly as you said. The amount of it that is permissioned and permissionless is largely going towards more of that sort of permissioned state at the moment. I do think when Clarity is passed, we are going to see, like, whether it's Ondo that's like fully like Ondo stocks are tokenized, right? They are tokenized stocks that exist on chain. Whether it's them that sort of like do all the repackaging and deploying that across all different kinds of DeFi, or it's somebody else that comes in and like uses what they've got and then repurposes it. Like we're going to have like something that exists, right? People are going to innovate on that.
Right.
Now the question is like, how much liquidity does that does that actually bring?
That's the point. They can't innovate on it because they they it needs explicit permission from the issuers for, let's say, a maple to accept biddle as collateral. I can't do it right now, so it's gate kept. Do you see, like, how, what would unlock that capital, and how would the gatekeepers open the gates for that capital to flow into, let's say, a maple or wherever, and build that innovative, DeFi Legos that DeFi is famous for.
I think, to be honest, I think the this is over my pay grade, to be honest, in terms of being able to answer how the
Let's,
the SEC is
let's
going to regulate like DeFi Legos that are specific to like Biddle and stuff. But I think like you can think about it from like a more you can think about it from like a bird's eye view, like a little bit cleaner, right?
Yeah.
I'm not convinced by any means that on-chain stocks are necessarily like the clear breakthrough, because why can't I just go into my Robinhood account and borrow against my Apple position?
Because I have, I mean, the thing you're missing is global access. Like, I live in India, I don't have access to a bunch of
For
these
sure.
equities. But now with Hyperliquid, I can just go there, and or with pre-stocks or with X stocks. I have a Tesla position, and I mean, it's easier for me to manage, right? Like, that unlock is what makes it very interesting. But yes, you're right. Like,
Absolutely.
if you're a Western audience and you can easily access those markets, then it doesn't really make any sense.
That is an amazing point, actually. That is the clear breakthrough. It is global. It is permissionless. You can do it from anywhere in the world. That is exactly the entire point of like of
Tokenizing equities.
yeah, exactly right. That is an amazing reason for it to exist. But the question is that how much liquidity does that bring on chain?
Yeah.
Probably not loads initially, but it's not about how much it brings, this year, next year. It's about like that entire and this is why, like I was saying earlier, like it's funny when you say like crypto is this thing that exists on its own. No, it's just going to be the infrastructure that underpins like. Well, this is what I think. This is why I think crypto has a very strong bull case. Generally, it's going to be the infrastructure that underpins like the future of finance. Now, whether or not that has value accrual back to the underlying tokens is like, that's the bets and the risk that you take by taking token bets.
Right.
The infrastructure, whether it's permissioned, whether it's Tempo, or whether it's on Ethereum, whether it's on whether it's on a permission chain or a neutral chain, that is where it's probably going to be. It's probably going to exist on chain. The end user isn't going to know they are using blockchain rails. Like, I don't know if you know, Santi, right? Santiago, he's building Inversion, and Inversion are like essentially just a company, well, like a project that are taking existing companies and putting them on chain. And by the nature of taking this existing company, maybe it's like, it doesn't matter what it is. Maybe it's a company that sells like shoes, whatever. By taking it, putting it on chain, they are reducing the overhead costs of that company. Let's say they can reduce overheads by 5 to 10%. Then that is literally 5 to 10% margin that Inversion has now got, which all exists on chain to scale the business further. Businesses do become more efficient on chain because the infrastructure that underpins it is better than the traditional than what currently exists. It's just that convincing businesses to move on chain is very, very hard sell. They don't like crypto.
Absolutely.
So you need someone like Santi going, crypto is missing users. It hasn't got enough users. How am I going to get users? I'm going to get users, put them on chain. They're not going to know they're using blockchain rails, but they're going to see the benefits, and this is going to be a better version of this telecoms business or whatever because it exists on blockchain rails. And that's what it needs. So crypto needs more users. That's all it needs. That's what it needs. How to capture those users is like where the most money is going to be made, which again is why like applications are likely to be the layer that are going to accrue the most value. Not least of all because that is typically what we see with internet, like with the internet anyway. But because they're the only areas now that are not priced to perfection. That is where growth needs to come from crypto. More users, more usage, and you can make the thesis for like tokens to be good or bad based upon that entire thing. Do they attract users? Yes or no? Are they going to pull people from outside of crypto into crypto? Yes or no?
Very cool. Very, very cool. Thank you for that very insightful take, Alex. Next section, probably the second last section, which is macro. Want to jump into Bitcoin a bit. I mean, you've extensively talked about Strike as well, so I'm not going to get into Strike. But in general, you have a global liquidity model, which called the BTC peak by tracking the rate of change of liquidity, but not the level of the prices, right? So, and that turned out to be right in hindsight. Where does that model sit right now, and what are the specific signals which would flip you from being cautious to being aggressively long right now? I know we're kind of choppy in a choppy state with Bitcoin right now. All of the buying, even from Sailor, is not happening. The FUD around Strike is definitely not helping. ETFs are dumping, if I'm not wrong. So, where do we stand on BTC, and what is the model telling us?
So that isn't actually my model. That is
Okay.
Michael Howell's model. Michael Howell runs Capital Wars,
Mm.
and he is he's been sort of like studying macro capital flows since the 80s, and he's like got some like thesis on this, and these things go in cycles, and the cycles goes from like stage 1 to stage 4, getting progressively sort of like more degen, as you go through, and then progressively sort of like more risk on, more risk off, as the sort of cycles play out. And he tracks global liquidity. And this isn't like if you go on TradingView and you put in like the global liquidity index, this isn't just like US M2 and China M2 and all that sort of stuff, which is like relevant by all means. But M2 is not the largest amount of money in the world. The largest amount of money in the world is money that is held up in it's like inside the like euro dollar system, right? Dollars that are sort of held in these offshore accounts. The shadow monetary base is basically what it is.
And what's the best proxy for that, which you can actually see on TradingView, let's say wherever, or as part of
Yeah,
this model?
TradingView hasn't got it right. Like the best place to go is like direct to Michael Howell and direct to Capital Wars, and he publishes, because he publishes this every week basically. He gives like an update, and obviously he's pulling all of these sources from all of the areas where he's like gained expertise over the course of his career. He has like had this model back tested against I think it was maybe Princeton University backtested his model and said, yeah, this is basically bang on for global liquidity anyway. So it's been like tested and verified in other sources. Not to say that, I mean, I really like Michael Howell. I think his stuff's amazing. But it doesn't mean like, be all end all, like, oh my God, listen to everything he says, because of course he's always going to be right. Like obviously he's going to be right and be wrong, but he's just like been tracking these flows of like global capital for a very long time. And these models are like, they're slow and they take a lot of time to turn by design, right? Because they can, like right now, well, for a long time, China were expanding liquidity, and now they're not. But like the Bank of Japan have been decreasing liquidity, the ECB have been decreasing liquidity, the US has been increasing liquidity. So it's like you've got, it's not clear the entire world is doing the exact same thing at one time. So you've always got ebbs and flows, of course. And so
is this a reactive model? In which case, how
it's a pretty
has the market price for Bitcoin already reacted after that? The model tells me, because
no. So the thing to watch is the change, right? The thing to watch is the rate of change. And so I took Michael's stuff and I was like, okay, I'm just going to put this in a dashboard, monitoring rate of change. So when maybe global liquidity goes from 185 trillion to 186 trillion, maybe it increases by $1 trillion, but the last like 3 months it was increasing by 5% a month, and now it's increasing by like 0.5% a month. That rate of change is the variable to consider, because then you haven't got to wait for it to decrease to like get some insights. And actually, when you look at this rate of change of like global liquidity, and you overlay that against Bitcoin price, it's obscene. It gets it like the peak every single time. I mean, it's completely wild.
interesting.
And so we saw that global liquidity rate of change peak in October. Obviously, it coincided perfectly with the Bitcoin peak. The same thing happened in 2021. The same thing happened in 2017. It's pretty mental, to be honest. It plays out
And
so
so
perfectly.
and so, what's the reading today in 2026 May?
Well, it's like continued, likely continued. Like the rate of change is continuing to slow, basically. And Bitcoin Bitcoin and crypto are like the most sensitive to those rates of change. And since October, Bitcoin's been struggling. It's just it's obviously come down quite a lot.
Yeah.
But the likely bottoming of this sort of like liquidity cycle, I guess, isn't until sort of like
Until the midterms.
2027 probably. Yeah.
Interesting. So we have more pain ahead. Oh my God.
Yeah, but I mean that's true, right? But I think like if you then go back, like this is how I'm playing it now. Like I think the more time goes on, the more likely it is that the low of like Bitcoin at 60K was the low, and maybe it gets retested again. Maybe you get like a tiny bit lower than that, but for the most part, I think that is there is good reason to think that the more that time goes on, the more likely that is to be a macro low. That's just how lows work. And for me anyway, it's like getting the exact low. It's kind of hard. If I go back to like 2021 or 2022, sorry, that sort of low, would I have minded buying Bitcoin at 24K, or would I have been like absolutely distraught that I didn't get it at 16K? Well, I would have been happy buying it at 24, to be honest. And if it went to 16, I would have bought it again at 16. So the risk reward for like trying to get lows becomes a function of both time and price. And so personally, this like correction now we're going through now, Bitcoin's at was like 73 this morning. I think we do see like 68K, maybe a little bit lower. I'm actually a buyer here, perfect for the next 5 to 10 years, and I'm perfectly happy with these positions going underwater. If they go underwater, I'm going to scale in further. But like I'm a buyer on this pullback basically, and I'm probably going to go underwater in those positions, and I'm kind of like fine with that.
Is this like a short-term signal for taking like swing trades, or is this more structural in the sense that, okay, BTC continues to go down, and so maybe if I don't know, if I bought in at levels around, let's say 60K, then maybe I should start selling right now and wait for the dip?
It depends on
like.
Well, it depends like on the person, the time
like
frame.
My question is like, if my time frame is longer term, like I'm a BTC bull, I'm looking to accumulate it for like 3 to 5 years. How do I use the model versus a trader who's looking to swing trade in and out on the liquidity regime shift?
I mean, if you're looking for swing trades over 3 or 5 years, then like you just want to be not buying when like at the peaks, basically. Anything like one or two standard deviation or two underneath the 200-day is like probably good value.
Got it.
At those levels, okay. Yeah, I think.
Wonderful. Okay. Next is your very interesting post, which was the you cover the Microsoft OpenAI divorce story. And one thing that caught my attention, and let me just lay down a little bit of the story. Bill Gates actually used to play bridge with Warren Buffett, right? And interestingly, Warren has never invested in Microsoft. It's also one of the most hated companies because, there are stories about how he would call in early stage startup founders, ask them to pitch and then steal their idea and build stuff. So Microsoft is actually built on a lot of like very ugly skeletons, very hated stock, yet has been one of the best performing stocks in the market. And now you put up the story that, okay, after this OpenAI divorce, Microsoft gets to keep all of the, good stuff, and they have actually no responsibilities towards OpenAI anymore. And they get to use the models for till 2030. They can build their own, applications and stuff on top of it, whether it's enterprise or consumer, and sell it. OpenAI, on the other hand, has the bad side of the deal. My question is, why this very specific call in a company like Microsoft, which has been the least innovative in AI? Like, we've seen the work that Google has done. They have been a pioneer in the AI space. Versus a Microsoft. Like, what do you see specifically about making this call versus, I can simply buy an ETF which gives me a broader semis or a AI basket exposure. So share your thought process around asking me to have, like, I don't know, a 2% position in Microsoft.
Well, for a start, like you should do whatever you want, right? You shouldn't take a position at because I like a specific 2% position at because I think I like Microsoft at some point. Definitely don't do that. But however, the reason so it's I guess it's threefold, right? For a start, Microsoft's been absolutely buried since sort of like August of last year. So it got killed in the sort of like SaaS apocalypse. 35% down is now 25% down because they got tied up in the whole SaaS apocalypse as Anthropic, and what we were just like releasing thing after thing that was just killing software or supposedly killing software. So the IGF ETF, which is like Microsoft takes up a big portion of, just got completely heavily sold off. So it was already pretty like disliked, right? So it's pretty disliked. It's kind of good. It's a massive company making a lot of money, really disliked, kind of good. Then they had this thing with OpenAI that basically meant that they've got all the IP of like OpenAI's model development,
technology, IP,
without needing to pay anymore for the
royalty.
For the fee of it. I mean, so if OpenAI are close to $1 trillion company because of their IP, and Microsoft can now leverage this whenever they want and not pay anything for it until 2030, well, that should make Microsoft more expensive, but it made them less expensive. That doesn't make sense. What's going on? So like, so that I was like, okay, this is weird. And then I sort of looked into it, and the long and short of it is like, yeah, they were heavily oversold. I don't mean like on the RSI, like just oversold, overbought is like a meme, to be honest. People are like, oh my God, I oversold. Irrelevant. Yeah. I mean, like actually people were getting rid of it a lot because they were overreacting to the fact that it was getting tied up in this software trade. I still think a lot of companies that leverage software are still going to do very, very well. You're not going to have like, you're not suddenly going to have these massive companies just going, oh, do you know our guy Vibe?
I'm just going to white code a HubSpot.
Yeah, exactly. Our guy Vibe coded this software that we've had on our books for the last 10 years. We're just going to go with it, actually, because it saves us, 10 grand a month. No, they're not going to do that. Obviously, they're not going to do that. And so it already got tied up in that sort of sell-off. Plus, then they have this OpenAI thing where basically they get to build, they get to use all the models that they're building, or the IP for that, basically for free. And then also, like, they are already in basically any machine, almost all machines in enterprise level anyway, and they're building more products that integrate directly into Word and Excel, etc. And guess what? Those things are still going to be really, really useful, and they're going to make people more productive. They're more likely to continue to get usage, and they're raising their prices across those products anyway. So it seemed like a pretty obvious trade. It's done quite well, to be honest. From when I entered it like 370-ish, and what is it, like 410 now? But I think this is more of a. I'm going to hold this for the next 6 months.
What do you think? I mean, just a quick follow up on what you just said, which is one thing you highlighted, if I remember from memory, in your piece was there is execution risk. Like, I mean, you made this argument that it's quite possible that they don't have the AI talent to build this out, which is probably why they went into this partnership with OpenAI. They invested in them as well, and that stake is now worth hundreds of billions. But do you feel they have the skill set in their team to actually leverage the IP and build solutions like enterprise grade AI solutions and services which they can upsell to their existing Fortune 500 customer base?
I mean, yeah. There's like, for sure.
Okay.
I don't think talent is going to be the thing that necessarily holds Microsoft back. They have like an enormous amount of money. They can get basically anyone they want for the most part. It's just like, of course, there's execution risk. Every company has execution risk. No company is guaranteed to execute their plan perfectly. For me anyway, the risk reward for like getting Microsoft. When they were like 35% down from the highs, as opposed to they're like a very good company. Like, don't get me wrong, the companies that go up the most are more likely to be the companies that continue to keep going up the most. Right, that is absolutely true. So like, not buying Google because it's already got up 100% or 100, it's basically done like 150% in the last like year and a half or whatever. Just because it's gone up a lot doesn't mean it can't keep going up a lot. That is actually like a a fool's errand that a lot of people, and myself included, in crypto, I used to always come into this issue, right? Oh my God, Bitcoin's expensive. I should buy like AVAX instead. I wish I could just like
Been there.
shoot that version of Alex, to be honest, because just because it's gone up a lot, the reason it's gone up a lot is because the market likes it. The market is more likely to continue liking the good thing than just suddenly turn around and liking the bad thing. Like me and every time I get Eric Crown on, actually, we talk at length about this. It's very common to want to buy the cheap thing, but it's cheap because it's the market's already told you like it's not the best thing. Now, obviously, you can sometimes buy lows and stuff, and that's completely fine. But the 50% of all gains in the S&P 500 are attributable to 90 stocks. 60% of stocks in the S&P do not beat treasury bills. These are not like shit companies. These are the top 500 companies in the US, right? Most of them don't beat US short-term debt.
Unbelievable.
Unbelievable. Unbelievable, right? It's unbelievable. And so to expect that on average, buying losers is a losing strategy. On average, buying winners is a winning strategy. Now, Microsoft are a winner. They have been a winner for a very, very long time. They might not be a winner, I guess, in 10 years. But this isn't like you're buying like you're not buying some random company that just has gone down 30% because they went down 30%. You're buying one of the largest companies in the world that have driven essentially like adoption of one of the most transformative technologies in the past and are likely to do the same thing in the future as well. And maybe they're not going to be the best by any means, but I think it's not like buying like an actual loser. Microsoft are obviously not a losing company.
Okay, I'm going to move on to the last section now. Just two more questions, but you briefly touched upon the SaaS apocalypse, right? The SaaS, all SaaS companies got like their market caps routed, and now you're in a situation where folks are still at bay. I mean, some of them have started to catch bids, but generally speaking, when you look at the current AI trade, and first it was Infra, now the number one topic on my CT timeline is memory, Alex, right? That DDR5 or whatever it is, DRAM, all of that stuff. I'm curious to hear your thoughts. Like already S&P 500, like Nvidia is what, 3% of S&P or more? The top
8%.
8% of S&P, they dominate, the big tech dominate the S&P returns right now. Everything else, as you said, is not making any money. And we are seeing like catastrophic valuation. Like Nvidia is more valuable than the entire GDP of India.
Yeah.
To process that statement is really hard for me, because here I have thousands of businesses, 1.4 billion people sitting right outside this room. And on the other hand, you have a company in Silicon Valley more valuable. How do you see how do you make sense of the current AI valuations?
AI right now is priced upon earnings and increasing earnings. So yes, the valuations are extreme. Yes, almost certainly those valuations are going to come back at some point. However, right now, they are priced upon increasing earnings. Nvidia is cheap. It's cheaper than Walmart in terms of its price per earnings. What? I'm not saying you should go and buy Nvidia at $5 trillion when it's almost 10% of the whole index. The point is, it's not being priced at these levels on pure speculation. It is making more money than anything has ever made in history, and it is making more money every single quarter than anything ever in history. So it should be the most expensive thing ever, and it should be priced in such a way that it's expensive, but it's not expensive. If you look at things like the build out in high bandwidth memory, right? When you had things like SK Hynix and Micron, these companies, right? They and obviously SanDisk as well. SanDisk was like the best performing company in the US last year. As SanDisk went through its 20 or 25x, whatever it was from low to high, it got cheaper in terms of its valuation. So this isn't like it being priced in a kind of quote unquote bubble. However, semiconductors or memory, these kinds of products, they're cyclical sectors. Now, what does that mean? It means they go up and they come down because they get really, really popular and then they get really, really cheap, like a bit like commodities, right? And the reason is because when suddenly you have a situation where everybody needs the same thing and there's a big bottleneck and only so many people and there's only so much that can be provided, you get over ordering, double ordering. Double ordering is something to be terrified of because it means that the same money is showing up in two different places at once, which means that somebody is going to not be giving that money across, which means somebody's earnings are going to be overinflated. Whose is it going to be? Who knows? But this is why they're cyclical, because the nature of like everyone needing the same thing from the same people at once means that everyone orders way too much, which means they order 3 months in advance, 6 months in advance. So what happens in 3 months or 6 months when they haven't got to order again? Like those orders drop off. So the expectation of future earnings drops off, but that's not how the market is seeing that earnings are ever increasing, right? So it's calling the top of the sort of like AI capex expenditure. AI capex is obviously going to be very, it would make you a lot of money if you could do that. Right now, these valuations are, I mean, it's hard to say it really, but they're arguably justified. The reality is though, it's the same thing with commodities, right? There's like an oxymoron or a paradox, sorry, in commodities, in that the worst miners or the worst producers of these commodities go up the most when conditions are the best, right? Because if I'm a gold miner and I don't make much money, right, or I lose money, if the price of gold increases by 3x, my margins go from a loser to a big winner, right? But the company that was run effectively with the gold price, they were already profitable, and now they're a bit more profitable. Yeah, it's good that they're a bit more profitable, but this company went from being a losing company to a winning company. So the reprice on this one is far greater than the reprice on the good one. So it's a paradox that shows up all the time in commodities. Like people who trade miners and stuff know this very well. The shit ones do the best in the best times, which shouldn't be the case, but it is. So it's not the same thing for these cyclical sort of like memory or semi industries, but it's a similar thing, right? The ones that are unable to continually meet demand, really unable, they're the ones that are going to go up the absolute most, right? Yeah, exactly. Yeah. Yeah, I mean, they're definitely things look like they're going to end at some point. um, yeah. Yeah, exactly. I mean, that's absolutely true. It seldom is. I think the IPO wave, when these companies do IPO, SpaceX, Anthropic, OpenAI, these things typically mark like cycle tops, right? They normally mark the top. Now, is that going to be the case again? Yeah, but I mean, like, there's three of them, right? And it's not that there's five, like whatever it is, 5 or 6 trillion that the market's got to absorb. The market's only got to absorb. I think SpaceX are basically doing like pure high float or low float, high FDV tokenomics. To be honest, they're dropping like 6 or 7% of the supply. So the market's only got to absorb, only got to absorb a few hundred billion, as opposed to the sort of like 2 trillion that's going to potentially drop out or whatever. Similar thing for OpenAI and Anthropic. So but they're talking maybe 500 billion to, $750 billion, maybe something in that region. The market's got to absorb. It's a lot. It's going to, you've then got the sort of like the kind of unlock effects of those of when the initial IPO buyers eventually unlock, or that has like this trickle down effect of like you're going to have net sellers. But these things are going to exist inside the indices for the first time ever. The indices are changing their rules to include these things, which they never have done before, right? Like NASDAQ and S&P are going to have SpaceX listed inside their first week. Normally it takes like 3 months for them to be able to be listed in these things. So they're going to have passive flows. The passive sort of like flow is incredibly strong, and arguably one of the entire reasons that the stocks will just continue to go rip to the upside no matter what, because you've got this like insatiable demand, this underlying bid that just TWAPs into equities every single month. And so algorithms are on the right side of that, and it's going to take a lot for that to unwind. So, I personally, I do think the IPA wave is likely to mark a top, whether it's the day, whether it's, a month afterwards. I think in 2 or 3 years we'll be like, that's pretty obvious in hindsight.
Nice.
But I think we probably continue on this path until Q4, maybe Q1 2027. And I mean, maybe this Nvidia earnings from like last week is like insightful in some way. They had blowout earnings again. They increased their expectations for next month, and the stock's down like 10% maybe. Like how much is Nvidia down now from its recent run after the sort of like Jensen in China thing? Jensen in China was trading at 236. It came down 10%. It's now trading just like teetering on this sort of like level that of its previous all-time high from October 25. No closures below there yet, but if it does close below there, you're likely going to see a sort of 190, maybe even $170 Nvidia after they've increased their earnings expectations. But I don't have like an awful lot of great insights really. I think it is, things are getting crazy. If you look at the valuations based upon history, yes, Buffett's indicator's been flashing, but Buffett's been getting into cash for I'm not to say that he's not obviously an amazing investor, right? Buffett's been getting into cash for the last like three years, so it could easily last 2 more years, right? Buffett's not trying he's not trying to say, well, I mean, the company aren't trying to say like the crash is happening today. They're just saying, look, these valuations are too expensive for us. These are not the valuations. These are not the prices we pay, and we're happy to wait 2 years, 5 years. We're not buying this market yet. So the fact that Buffett is in a lot of cash, people have been saying Buffett's been in a lot of cash for a year and a half. And now it is something to look at and definitely is insightful, but it doesn't tell you the timing.
I feel people are struggling to, they realize this, but they're participating anyways because they don't have the cash pile that Buffett carries, so he can do pretty much what he wants. The other thing is we're living in this rapid inflationary regime for the longest time. That was the BTC thesis, right? That is the BTC thesis. Even today, it is the finest form of digital inflation hedge against the global currency crisis that's going to happen. And I feel people kind of realize that, and so they are participating in these cycles today at whatever valuations because they just don't know where to park their capital and they don't want to keep it in cash. Maybe, I don't know.
Yeah, I mean, they've made it, right? Like, obviously, Buffett made it a long time ago. Doesn't need the returns of the market. The average, like Joe or Jane, is not a market timer. They should invest whether the prices are high, whether prices are low. They probably should just DCA nonstop. That is what the average like investor, index investor, has been successful with in the past. They probably likely will remain successful with that in the future. That is like you make more money buying stocks at all-time highs than you do at any other time. Mental. Doesn't make any sense. That's just like the stats are the stats, right? Doesn't mean that I think this is something that people should be going ahead and like buying necessarily right now, but it just I think there are lots of opportunities, right? There are lots of things there are lots of opportunities at the moment, and I think there will continue to be. but the amount of like research required to capitalize on those is a lot, right? And if people aren't willing to do the sort of like time and the effort and the sort of like constant like sell their soul to like look at all this stuff, then they should do the easy thing and just like, you know, probably
by the
passively
index.
invest or whatever. Yeah, by the index.
Which brings me to the last part of this podcast, Alex. Like earlier, I was hearing you in a separate call. You were talking about how AI has completely changed your workflows, your life, your work. It has influenced you and made you a lot more productive. So my question is, can you briefly touch upon how you think about AI right now in terms of now that you have real experience using a Claude code, a Hermes agent, right? Things that people are reading on X and thinking, like, how do I even get started? Where do I even get started, right? They're having this challenge right now. So just walk me through your story on how did you get started? And two, what's your end goal with it? Like, is it like, I want to make more money? And so, you just said like, you have to process so much information as an analyst. So AI allows you to do that better. Give me one or two like practical examples of how that has made you a better analyst and a podcaster, and a media personality in crypto.
So, I mean, in terms of analysts, it's obviously helped like nothing else I could possibly imagine. I can now build things that like take what's in my head and put them into like easy to sort of digest dashboards super simply, which is incredibly valuable to me, because otherwise I used to spend like hours in Excel just messing around trying to make things like look some kind of way, because I can't code, right? And it would just be a complete waste of time. Whereas now I can just be like, all right, I've got this idea, just go and chat to Claude Code or whatever it is, and like I want to analyze like from all of history what were, like, for example, right, I want to analyze from all of history what was the return of T-bills ever since the invention of the Fed. This is really useful information, right? Because you can then compare that to the price of gold over that time, the price and the returns of the SPX over that time. This is really useful because everyone says, oh, the dollar has gone down 99%. Absolutely true. But you shouldn't look at a dollar like a dollar under a mattress, because the fair price of a dollar is a dollar plus inflation. It's like if you had Solana, you wouldn't be like right now the price of Sol really is Jito Sol, or like staked Sol, marinade staked Sol. What is the price of that? That's the real price of Solana. So because it has this constant inflation, like the same with ETH, you shouldn't really look at the spot price of ETH. You should be looking at the wrapped stake price of ETH. That's the real price of ETH, right? The wrapped stake price of ETH looks much better than the price of ETH because it hasn't got this continued inflation built into it. That's what a treasury bill is. So over the last, like, whatever it is, 100 years, actually dollars have like done a 27x. So they've only underperformed gold by, I think it's something like 3x, which is nowhere near as bad as the alternative, right? So yes, of course they're not the best thing to hold for long-term capital appreciation, but it's much better than just having like than just having the dollar, right? So anyway, like, it's allowed me to like build these things and understand much greater, like the questions that I have are much easier to answer, I guess, is one thing from that perspective. In terms of like podcaster and stuff, I mean, organization is like one of my lowest ability skills. I'm terrible at organizing things. And so having like literally a PA that does all my cold outreach to get guests on, emails them, does the hard work of like finding the emails, getting hold of them, then staying on top of actually replying to them. This stuff obviously doesn't sound like that crazy to most people, but like, honestly, like for me, I need help with organizations.
I'm right there with you, pal. I hate that work. I hate the grunt work of operations. Curious on the cost. Like, is it very expensive? Do you spend like thousands of dollars to run this setup? Or
no, definitely not.
Touch upon
I only pay for the $100 Claude subscription. I max it out quite a lot, to be honest. And then I also have like a Hermes agent that I probably spend like. I have just like changed something to hopefully it reduces the cost a little bit, but the maybe like $250 ish a month on subscription on costs of like AI, which is like pretty good value, to be honest, I think.
Interesting. And very quickly, I mean, I was reading a news that Anthropic will be rolling out some guardrails that you can't use your existing Claude Code subscription with like third-party agent harnesses like Hermes and others. You have to use Claude Code, or you have to use a pay-per-use model, right? Do you think that's going to make like life difficult for you, or more expensive because you will have to pay per use and top up? Was you can't use it with your like $100 pro max subscription?
Yeah, well, I think I think the reality is, right, the OpenAI and Anthropic are subsidizing usage heavily right now. If you use the subscription models, they're paying like 25 to 1 on your dollar spends, right? So if you max it out. They're going off the standard subscription model that most people who pay a subscription are not going to max it out. Fine. And a lot of people don't. That's absolutely true. But the people who do, and really max out, they hit their levels every 4 hours, or every 6 hours. I can't remember the exact refresh time. Is they're subsidizing the usage by like 20 to 1, 25 to 1, which is crazy, right? So like for me, they're definitely subsidizing a lot of my usage. I don't max it out like every single hour, but probably twice a day I'm maxing out my token costs. And so if I wouldn't be able to afford, well, I wouldn't want to pay actually. I wouldn't want to pay what it would truly cost.
$2,500 a session
I wouldn't want to pay
a month.
I would be much more inclined to try and find like cheaper alternatives.
Then switch to like these Chinese open source local models like Kimi and
100%.
others. I'm saying like they are fraction of a cost of Anthropic, bro.
Yeah, 100. I would absolutely be doing that for sure. And I think I probably will. The reality is, I think we're about I think in like 3 to 6 months, we're going to look back at this time, and it's going to be like, oh, remember when Uber were paying for us to go to get rides, and we could get a ride across town for $5? Like now it costs like 50. Like, I think that's probably going to be the case. You're just going to look back at this time and be like, oh my god, this stuff's so expensive. And this is why I think more than ever, now is the time to like really use this stuff, because basically it's never going to be this cheap again, or unlikely to be this cheap again, unless there is the argument that like model development is going to get more efficient, and you're going to be able to store it locally and all that sort of stuff. Hopefully true. I really, really hope it's true. But that hasn't been happening so far. As we've seen agents get better, as we've seen models get better, what that's meant is these models have required more token usage per query, right? Per request, and so the demand for tokens is ever increasing, which is the entire like thesis for
correct
for memory and for semis anyway, right?
Infra trade.
Because you're seeing Jevons paradox play out in real time. As things get more efficient, they're getting used more.
They're getting used more and more. Yes. Okay, I want to come to the end. I think we've been talking for an hour and a half. So thank you again, Alex. It was wonderful. But I want to end with, actually, it's a two-part question. So one part is, if there's one mental framework which the listeners of this podcast should go away with. Okay, Alex has been in crypto 5 years, has talked to the big wigs of crypto and TradFi now as well. And he trades a lot. He's a fundamentals thinker. He believes in conviction, like so many ideas. But what is that one mental model that you would want the audiences to go with, and your closing advice to them?
I think you cannot borrow conviction. I can't express this enough. It's all well and good listening to people, getting ideas from people, actually having people do a bunch of research for you and letting them synthesize that research in whatever form it is, podcasts or Substacks or whatever. Amazing. Take all that information in. You cannot borrow their conviction, because the only way you get conviction in something or an idea is by understanding it, understanding the bull case for it, the bear case for it, the base case for it, the steel man, the other side, still man, the side you want to have. And even after you do all that, you're still going to get shit wrong, right? But the point is, you have an idea that is based upon like basically evidence that I'm not even saying you have to collect the evidence. People say do your own research. It's not even do your own research. It's do your own reading. It's read some stuff. Most people are not researching shit because they're not having to go to like the nth degree to find out like where's that company registered, like who sits on the board. A lot of this stuff's already done. So fine, utilize the fact that it's already done, but you can't borrow this conviction, right? And I think this is the most important thing for investing generally. Like Stanley Druckenmiller one of the most successful investors of all time, because he takes a few concentrated bets and studies them religiously and does nothing else but just be obsessed with these few things. Most people do way too much and try and be like, and hold way too much, which basically means they hold an index. So you can hold the index in that case, because then you can't lose to the index at least. And they borrow conviction from everyone else. They borrow conviction from their favorite influencer, which is why when, you know, token price goes down or asset price goes down, they get annoyed at that person for being like, you told me to do this. And it's like, no, they developed an understanding, they developed a thesis. That thesis could be right or wrong, but they pulled evidence and they inferred the world in 1 or 2 or 5 years.
Yeah.
The world is unpredictable. Most people are going to get stuff wrong. As we said at the start, the idea is to get things, when you get things right, you get paid more than when you get things wrong. But it's just to understand that you can't borrow conviction, right? And it's being able to like buy things when they're cheaper, because that's the time to be like, to deploy your conviction, rather than wait for them to be expensive and then like be convinced because everyone else is convinced. Being convinced because like the price is green is obviously the trap that most people fall into. They buy things when they're expensive, they sell things when they're cheap, and this is obviously just this constantly perpetuating loop. All boils down to they borrowed conviction from somebody else, and they couldn't see their thesis through. This doesn't mean, by the way, you should not cut your losers or change if the thesis changes. This does mean whatever you decide to do with your time, with your money, is your decision, no one else's. And the only person who's responsible for those actions is you. And if that doesn't sit well enough, they shouldn't be like investing, they shouldn't be doing this sort of shit. They should just be, have a financial advisor and, you know, go down those routes, because you are the master of your own destiny when it comes to like returns, right?
You know, I just don't feel like asking the last question because this is such a beautiful ending to this podcast, but I am compelled to, because this is one token that you have shilled more times than anything else you've ever written about or spoken about. So I'm talking about TIBBIR. And what is it? What is your love relationship with TIBBIR? And I don't want you to get into the thesis, but just in one line, right? What would stop you from no longer believing it? Like, what would kill that thesis?
Yeah, so I mean, so I want to be clear. I haven't really shilled TIBBIR anywhere other than like in a private Discord.
Of course.
And it's more like, so what it is unknown. Okay, you don't know what it is. Okay, now who's behind it is arguably unknown, but there's a bunch of breadcrumbs, a bunch of like circumstantial evidence, a bunch of things that are like, I think, too smoking gun to ignore. And it ties it to one particular person who is like arguably the best fintech investor of all time. Now, if there is a liquid $100 million market cap token that is tied to the best venture capitalist fintech investor of all time, who has a history with investing early in Bitcoin, understanding what it's useful for, understanding the future of finance, understanding what programmable money is, understanding that the layer that sits underneath what the world is today and where it's going to be in sort of like 5, 10, 20 years is the interaction between AI and blockchain, and those two things interacting with an end user, that end user not needing to make decisions, that end user being able to just speak to whatever interface it is and get whatever it wants out of its plane tickets or it's just like general requirements. That is arguably what the breadcrumbs of TIBBIR have like left. Now, whether that is or isn't true is largely up for debate. And right now, the market thinks it's not true, right? There's no doubt the market right now is saying, yeah, it's not the case. Now, the reading and the research, I've done like extensive research into this, and I think it's very, very hard, to be honest. It would be weird, from my perspective, for this to not be tied to Mickey and Ribbit, because they've had ample time to distance themselves. And these guys are nothing more, these guys know there's nothing more important than their
reputation.
reputation, exactly, right? Because they've been spending 20 years building this incredible reputation across that entire space. And so the fact that they've left like TIBBIR breadcrumbs in their videos, like they've shown you the picture of it, they've done, and like not just that, right? The Mickey's got like Robinhood shares that are listed underneath TIBBIR LLC with the SEC. Like there's like legitimate, the wallet that deployed TIBBIR was Mickey's original Ethereum address. It's got like $4 million in fees sitting in it, hasn't been touched since TGE. Like, you know, I don't want to go into
And so
all of the detail.
what would the re-rating event be? Like, is it going to be like Mickey coming out and blessing TIBBIR publicly or something like that? Like, what do you see?
I mean, like the website is literally like their website now. I mean, for all intents and purposes, is literally like if you look at it, the website should be Ribbit, right? And then it's like the R's flipped around so it reads TIBBIR in the back direction anyway.
Interesting.
With the same like font, the same text, you know, whatever. So you asked me what would falsify it.
Yeah, what would falsify the thesis?
Ribbit saying this isn't our thing, you know, like distancing themselves. If they distance themselves, I'd dump it immediately. If they all started to like unfollow the account, right? 10 members of Ribbit Capital all follow the little frog, right? If they came out and said, this is just a meme. To be honest, if they came out and said this is just a meme, I'd probably still hold it, right? Because I think that like memes can be worth quite a lot, and a meme that's tied to the largest VC, you know, company of all time with like, I don't know, whatever it is, $5 billion in AUM. You know, might be worth like speculating on. Initially, it would be like it would be an incredible dump, right? If they come out and distance themselves or said this is just a meme, this is just a joke, we're not really doing anything with this, then it would probably go down to like sort of 10 mil. I would imagine. It would be like a 90% drop, but I would imagine it would be they would have like some plans with it. But if they are tied to it in any way, if they admittedly like this is ours, this is our meme, this is our actual infrastructure token, whatever it is, then I wouldn't. Say that I don't think. If they come out and distance themselves from it, then like I'd sell it immediately.
Wonderful. Okay, that brings us to a close, guys. Thank you so much, Alex, for being here. So, guys, we talked about his frameworks. We spoke about, contentious points between his thesis and mine. And now we are ending with TIBBIR. Great podcast. I had a lot of fun. Just time blew. Time flew past me.
Thank you for having me, sir. It's been great fun.
Thank you, Alex. I'll see you again soon.
All good, man. Ciao, ciao, guys.